The danger is in the ledger line. China's official debt looks tidy, but the real leverage lives in side rooms, provincial vehicles, state firms, lender guidance, and quiet rollovers. When that wiring hums too hot, strain moves from paper to concrete. Pause for a coffee, because this one mixes two strong shots. On one side, calm 10-year yields and a tidy headline debt column. On the other, LGFVs, rolling short paper, land auctions clearing light, and households still waiting on keys. It's like sipping an espresso while staring at a half-finished tower, bold on the nose, but you can't live in a smell. This wasn't a side note. It became the book. Look at this. Headline debt sits neat, but the shadow stack, local financing shells, state giants, and directed credit turns a footnote into the main story. The tidy column you see isn't the system you feel. Think of this as a high-rise with hidden floors. Walk in and it's 20 stories. Open the service door and you find 30 more. The elevators run smooth until one cable frays. Here's the clean number. This is what makes it into the official books. Central government plus provincial debt, about 88% of GDP. But that's just the first ledger. To really understand the picture, you have to layer in the parts that don't always get filed as government debt, yet behave like public risk when things turn. The first edition is LGFVs, local government financing vehicles. Think of them as project companies. They build the roads, lay the rails, and put up the parks, often funded by land sales and bank loans. On paper, they're corporate, but if they stumble, no mayor lets the lights go out. Next comes the S.O.E.S, state-owned enterprises. Some are solid, profitable businesses. Others carry missions that serve policy goals heavier than profits. If they start to slip, the state steps in. Not out of love for shareholders, but because the function itself is too important to fail. Now zoom the camera back and look at the full right-hand bar. It towers above the official one. That gap is the story. System-connected liabilities that don't show up on the front desk ledger, but that everyone knows are part of the room. That's the key. They may look corporate, but they act public. Because when the cycle turns, the question of who absorbs the loss isn't answered by a spreadsheet. It's answered by policy. And this is why markets can look calm even when the debt is heavy. 10-year yields don't scream. State banks quietly absorb the flows. Savers don't have many exit doors, and guidance helps shape the curve. That calm can be genuine until it isn't. And sometimes calm is less a reflection of safety and more a reflection of gates. Think of China's balance sheet like a set of rooms in a house. Each room holds a different kind of debt, and each room has its own rent, the cost of keeping the lights on. The first room is the central government. This is the cheapest funding in the system, clean paper, direct lines to policy banks, and the full faith of the state. The second room is the provinces and local governments. Funding here is more expensive, more uneven. They lean on land collateral, and they work closely with local banks. The costs can shift quickly. The third room is the maze, local government financing vehicles. On the surface, their bonds don't look too painful. Coupons print fine in the public data, but the real bill is bigger. Fees, guarantees, and relationship pricing that quietly push the cost higher. The fourth room is the state-owned enterprises, and here you really see two tribes. On one side, the cash engines, energy, telecoms, shipping, these fund easily. On the other side, the heavy industrials and the builders, they pay much more. The dot above this column tells the truth. Policy can trim the sticker rate, but it can't erase the underlying spread. The last room is households, mortgages, and consumer credit. When people trust that homes will be delivered, they carry the leverage quietly. But when delivery slips, that leverage flips into hesitation and spending pulls back. The taller the stack and the higher the dot, the less room there is for mistakes. This is also why consumer prices stay sleepy, even when debt is heavy. Households don't overconsume. Shop prices don't chase. Instead, the pressure shows up in assets. When homes are treated as the savings account and stocks don't inspire, cash runs to concrete. The strain doesn't show up in the CPI, it shows up in land. Here's the puzzle. China's money supply hasn't just grown, it's exploded, more than 20-fold since the year 2000. Every 5 years, you see another step up. Every policy wave leaves the base higher than before. Stimulus windows open, crackdowns close, but the line never drifts back down. It just compounds upward. This is broad money, what economists call M2. It's cash, deposits, and the credit created through banks that can fund projects almost on command. It's the scaffolding of liquidity that props up land sales, local vehicles, and construction starts. Each pulse of lending becomes part of the permanent stack. What makes this remarkable is how steady the climb looks. There's no crash in the series, no retracement. Even when growth slows, the money stock itself ratchets higher. In effect, China has built a financial tide that only flows one way. And that sets up the deeper question. If money creation runs this far ahead, where does the pressure show up? Not always in grocery store prices, but somewhere else in the system. To answer that, we need to follow the trail from liquidity into assets into the housing market. If you want to know how Chinese households feel, don't look at GDP or stock tickers. Look at housing, starts, sales, and completions. 3 lines that tell the mood of the nation. Follow the starts line. This is the promised pipeline. Cranes on the skyline. Credit in motion. Now follow sales. These are the pre-sold units, the cash that funds the promise before the walls are built. And finally, completions, the promise kept. When the blue line for completions hugs the orange line for sales, households sleep easy. But when completions sag beneath sales, shade the gap. That gap is trust risk, families paying for rooms that don't yet exist. Drop in the policy bands, finish the homes drives. When the blue line pushes back up, keys change hands, and that single act calms more balance sheets than any press conference ever could. If one chart explains household mood, it's this one. Keys cure, delays echo. Now zoom out to the funding side. Servicing risk is uneven. Central obligations roll cheap. Provincial shelves roll higher. Some state-owned enterprises face double-digit funding in side channels. The more scattered the stack, the greater the chance one tile slips at the wrong hour. And cash doesn't like mazes. If a platform borrows short to fund long concrete, stability is rented by the quarter. 1 week auction or one soft land sale season, and cash trails invoices instead of leading them. If housing tells you how households feel, offshore bonds tell you how the outside world watches. These bars are the maturities coming due, what China owes in hard currency stacked by sector. Start on the left. The second half of 2025, about $90 billion. A big slice is financials, steady issuers who usually roll with state backing. But look at the yellow, local government financing vehicles. Offshore investors call them Chengtu. They carry land and concrete risk, not always matched with cash flow. Now step to 2026 and the stack jumps higher, around $130 billion. The gray layer swells too. Corporates that aren't banks, aren't Chengtu, but still depend on refinancing windows. This is the peak maturity wall. By 2027, the total dips a little, but notice the yellow grows again. More LGFVs leaning on offshore markets, even as domestic channels tighten. So what do these towers mean? Offshore bonds are small compared to China's vast onshore credit system, but they matter because they're harder to roll quietly. Dollars are visible, and missed payments travel fast. Think of it this way. The housing chart shows trust at home. This chart shows credibility abroad. One measures households, the other measures investors. Both decide how much room the system has to maneuver. History doesn't repeat, but sometimes it rhymes. Think back to Japan in the 1990s and 2000s. First, an asset boom burst. Bad loans piled up, but instead of being written off, they were rolled forward. Banks kept weak companies alive, so-called zombies that dragged on the economy. Prices slowed, even slipped toward deflation. Local governments and special project firms carried debt they couldn't support, and cleanup came in waves, slow, drawn out, handled by asset managers. Yields stayed low, not because everything was healthy, but because savings were trapped in the system and growth stayed weak. Why does that map to China today? Quiet leverage, a property-heavy economy, guided banks, and the long grinding repair that follows excess. But here's where it differs. China's capital gates are tighter. Local financing vehicles are larger in scale. And household pre-sales sit right at the center of completion risk. Done right, consolidate and term out, fold weak LGFVs into transparent provincial shells, swap short paper into longer policy bonds with a clear published calendar. Finish first, ring fence, pre-sale cash, guarantee the keys. Narrow the equity lane, steady the rules so savings have a home beyond concrete. Done sloppy. Extend and pretend, bunch tomorrow's maturities, hide today's losses. Campaign crackdowns, spook equities, shove savings back into towers. Delay the keys, treat households as buffers. Confidence drains, then snaps. If you want straight, no fluff breakdowns when rules shift and markets re-rate, hit subscribe and ring the bell. Drop your take in the comments. With debt far larger than it looks on paper, should leaders focus first on cleaning up the balance sheet at home? Or can they push ahead on both fronts, repairing trust inside while projecting strength abroad? I want to hear how you see it. History rhymes. Power rebrands. Stay inquisitive.